This is the Asia Trade. I'm Chevryan in Tokyo.
I'm Heidi Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set to catch a tailwind from Wall Street as the S&P 500 extends its rally to 6 sessions. Strong US retail and jobs data bolstering the hopes of a soft landing. JD.com shares jumping in New York as earnings beat expectations, but Alibaba's revenue misses estimates on weakness in its core e-commerce business. And China's central bank chief pledges further steps to support growth, but warns it won't be anything drastic.
And really, Heidi, that change in narrative and sentiment across markets after we saw a lot of more optimism, at least at the end of this week, given U.S. retail sales numbers really adding to that narrative that perhaps is not all doom and gloom. There was a lot of concern that we could see Americans tightening their wallets and really not going out to spend if the U.S. jobs market weakened. But we saw retail sales accelerating in the month of July at the fastest clip that we haven't seen this year. So we continue to watch all of those economic numbers, especially after inflation also came in tamer than expected this week as well.
Yeah, and it's going to really set up for a very interesting Jackson Hole, right, given that at this point, every data point, every piece of Fed commentary is just so closely scrutinized in terms of the easing narrative that's being set up. So we'll be firmly focused on, of course, Fed Chair Powell. He is expected to speak on the economic outlook at the Jackson Hole Economic Policy Symposium. The Fed really confirming that they'll be speaking on the economic outlook at 10 a.m. Eastern on August 23rd. So this is really the precedent where the Fed chief gives a keynote address during this 3-day central bank powwow, if you will. So we'll be watching really all of the narrative coming out of Jackson Lake Lodge in Jackson Hole in the next few days or so. So we're also, of course, listening to other bits and pieces of Fed speak. We've had some commentary, including from the St. Louis Fed president, talking about how close we are when it comes to the start of this easing cycle.
From my perspective, the risks to both sides of the mandate seem more balanced. Accordingly, the time may be nearing when an adjustment to moderately restrictive policy may be appropriate.
Also really helping sentiment was the fact that we saw jobless claims falling for a second week to the lowest level since early July. But take a look right now when it comes to U.S. futures trading at the moment. We are seeing a little bit of upside after those gains for 6 consecutive sessions on the S&P 500. We're talking about gains of more than 6.5% during that stretch of time, which really hasn't happened by that magnitude since 2022. NASDAQ futures also pointing to the upside. We saw Treasury yields also surging less than 100 basis points of rate cuts now being assumed by the markets. And with that, of course, we saw the dollar also gaining ground. And on the other side of the trade, we're watching Japanese yen. Take a look at how futures are coming online because the Japanese stock market really has been on that recovery trend. We're talking about gains for the past 4 consecutive sessions after, of course, that sell-off last week. We're seeing gains of 0.3%. The ASX 200 also showing futures up by about 1%. We'll be watching the open in China as well as we got, as expected, some sluggish economic data. The offshore yuan right now holding at that 718 level. We'll get a little bit more indication of where the Asian economy is headed with non-oil domestic exports coming out of Singapore as well later today. But let's get more perspective with the markets, with the economy, with Shane Oliver, Head of Investment Strategy and Chief Economist at AMP. Shane, always great to have you with us. Give us your assessment of what's been happening in the last few days and where we head from here, given, of course, all of this sort of mixed economic data that we're getting from all of these different countries.
Well, I think what we've been seeing in the last couple of weeks is a sort of volatility that comes about as a result of a significant monetary policy cycle globally. Investors worrying whether central banks have gone too far. On the other hand, the economic data is still not quite consistent with recession. Yes, we've seen that big rise in unemployment in the US, and there's been a rise in Australia, the country I'm in, but it's mainly been due to more workers entering the labour market as opposed to a decline in jobs. And so that makes it a different sort of picture. If we were seeing more job losses, then it would be a lot more negative. And consistent with that, of course, the US economic data overnight was more positive than many had feared. Good retail sales figures, business surveys sort of okay-ish, but not flash. Jobless claims down a little bit, suggesting some impact from Hurricane Beryl. back in July. So all of those things, I guess, providing some comfort to markets. But the volatility, I think, is likely to remain high. The risk of a further correction still remains high as we go through this seasonally weak period, August, September. And you've also still got that recession risk in the US hanging over the markets to some degree, although I think ultimately will be avoided, but we could just go through a bit more volatility.
And Shane, obviously, aside from what's happening here in Japan, can we firmly say now that the world and major economies have entered this easing cycle that obviously started from EMs, but we saw the Philippine Central Bank cutting rates yesterday. We saw the RBNZ also cutting rates this week. What does this mean in terms of monetary policy going forward and the markets are pricing in these rate cuts?
Well, it's an amazing turnaround. A couple of years ago, something like 70 to 80% of central banks globally were raising interest rates. Now you've got 30% after, of course, New Zealand joining in and the Philippines. Yes, as you're right, it did start in the emerging countries, but you've now got several developed country central banks now cutting interest rates. And it reflects I wouldn't say coordinated, but we do have the reality that as we went through that cycle couple of years ago, inflation picked up everywhere. Now it's been falling everywhere to greater or lesser degrees. Some countries a bit less, some countries a bit more, and central banks are following that down with lower interest rates. So I think it has to be seen as a positive sign. If the global central banks can pull this off, they've done very well. We had a huge surge in inflation 2 years ago. Now that's coming back under control. We've seen many central banks with inflation down or around their targets. And, of course, so far economic growth remains sort of okay. Some countries not fantastic, but it's still been okay. So if we can manage to continue to get rates down and avoid recession, then that's a pretty good outcome for markets. And I ultimately think that will underpin good gains over the next 6 to 12 months, even though the next few months we could see more volatility in markets.
Shane, does it look like the RBA increasingly will be the outlier, right? We're expecting Michelle Bullock to again reinforce the pushback against any kind of imminent easing narrative, and we see those bets being unwound. Growth is still not great, but the labour market flies in the face of any, further dovishness.
That's right. I think Australia will be the laggard, just like it was a laggard on the way up. It was one of the last. I think the ECB was probably the last. We were just a little bit before them in raising rates, and we're going to be a laggard on the way down. But I think ultimately we will follow. Just bear in mind, yes, if you take Canada, for example, they've got 6.5% unemployment. We've got 4.2%. But our unemployment rate is basically the same as the UK and the US. The UK has started cutting rates. The US is pretty close to it. They'll be cutting next month. Look at wages growth. Wages growth in Australia is lower than in both of those countries and lower than in many other countries that are cutting interest rates at present. And services inflation is higher in the UK than it is in Australia. So I think when you look at all the economic stats, there's some that point in a more hawkish direction, others that don't. So I think, yes, we will lag a little bit. Quite clearly, the Reserve Bank is still concerned inflation is still too high here at around 3.8% or 3.9% if you look at the underlying. And that will keep them on hold for a while longer. Yesterday's job figures don't provide any urgency for the Reserve Bank to respond. Unemployment is up, but it's still low, and we're not seeing big job losses. We're not seeing job losses at all at present. So those things keep the Reserve Bank on hold, but I think ultimately they will fall into line and we will start to see RBA rate cuts from February next year.
What if we see further weakness when it comes to the China-Australia correlation, right? Iron ore clearly going through a world of pain at the moment. The steel situation doesn't seem to look like it will improve in China anytime soon. Do you have sort of visibility in terms of how that could play out? And also if you see any opportunities that are at all compelling within the China space right now?
In terms of the impact on Australia, I think that has to be seen as a negative. The iron ore price pushing below $100 a tonne. It's well above what the Australian government is assuming in their budget. But nevertheless, it will be a drag on the economy. That support that has been coming from high terms of trade, high commodity prices is fading a little bit at the margin here. And so that is a bit of a drag for Australia and is something the Reserve Bank can't ignore. And in terms of China, like I think on a sort of a medium-term view, the Chinese share market is good value. It had that nice bounce earlier this year. There wasn't much follow-through. I think Chinese authorities will continue to provide incremental stimulus as opposed to massive post-GFC type stimulus. But that will probably be enough to keep the Chinese economy bubbling along and probably also be enough to ultimately support the iron ore price. I don't really see it falling much below $80 a tonne. So I think there are opportunities in China and in relation to China plays. I think ultimately we're going to have a situation here where material stocks get oversold, big miners and so on, the iron ore producers. And likewise, I think there are opportunities ultimately in the Chinese share market. But would you rush in right now? Probably not. It'd be a bit like trying to catch a falling knife. You'd probably want to see more evidence of that stimulus coming through in China and more evidence that Chinese economic data is stabilising. But I think it's something to watch over the next couple of months.
Talking about falling knives, Shane, we have seen, of course, a free fall in the Japanese yen for most of the year. We saw that incredible rally just a few days ago, just to reverse most of that rally as well. We're seeing again back to that downtrend towards the 150 level. I do wonder what your perspective is on what the Bank of Japan can do at this point or is willing to do, because we saw that rate hike in July just to be followed up by some backtracking saying that they will not move again if the markets are unstable. And yet you continue to see data that perhaps supports a stronger economy. Real wages turning positive for the first time in more than 2 years. We're seeing also GDP growth rebounding in the second quarter. Where does Japan go from here?
Well, it's messy, and I think it just highlights the problem Japan faces, that when you make these little incremental changes...
probably explains it.
Yeah, like moving from zero, you sort of, they are big interest rate increases when you look at them in a percentage terms from where we come from. And that obviously affects the so-called carry trade. And that's why we're seeing these huge gyrations. A couple of months ago, the big concern was the big collapse in the yen. And then, of course, it came, the big concern switched to the big rise in the yen. It's all very messy. It does make life difficult, I think, for the Bank of Japan. But ultimately, as their economy continues to grow, and I think it probably will, and inflation hovers around that 2% level, depending on which measure you look at, but it's around that give or take, that will probably see more monetary tightening. And when markets are stable, we probably will see more moves by the BOJ. But it's going to be a very slow process. We may see one more hike by the BOJ. I don't think it'll be 25 basis points, but maybe 10, 15 basis points by the end of the year. But you just have to allow that it is a slow process, and the carry trade will gradually unwind, but hopefully not as quickly as it did, or as it started to a couple of weeks ago.
Shane, always great to chat with you. Shane Oliver, Head of Investment Strategy, Chief Economist at AMP. Coming up next on the Asia Trade, we ask Sigma Lithium about where they see the most demand coming here in Asia. Here, M&G Investments says South Korea remains an underappreciated market. We're also counting down to Indonesian President Joko Widodo's final budget speech. This is Bloomberg.
Take a look at Chinese tech ADRs. Of course, we have seen a very busy earnings week. Alibaba really not doing much after posting an anemic rise in revenue. Chinese commerce business, its Chinese commerce business sector shrank for the first time in at least a year. When it comes to Tencent, we saw some gains. Of course, we had seen that beat when it comes to the results. The profit gain was about 47.6 billion yuan, while sales were in line with expectations. When it comes to JD.com, we also saw a strong profit beat. A little bit of a mixed picture across the board, but of course this, as we continue to watch the Chinese economy and how that's affecting these e-commerce businesses. Our tech reporter Annabelle Jewellers joins us now. Belle, so a mixed trend. What did we see in terms of Alibaba first?
Yeah, as you said, it really was that concern around how much the weakness that we're seeing in the Chinese economy, Chinese consumers in particular, how much that played into the results. And it was very much plain to see for analysts because the numbers did not hold up to expectations, as you said. We saw overall revenue, for instance, climbing around 4%, but profit was down 27%. And the company as well really taking a hit to margins because you can't just forget that it's not just the economic story in China, it's also the story of a very, very, very competitive landscape where you have more established players like Alibaba, JD.com, PDD, but also entrants in the space as well that are really fighting for the same amount of market share that's shrinking given the weakness in the Chinese consumer. And so that also took a toll on the company as well because we saw operating margin falling to 15% in the most recent quarter. It was earlier 18%. There were some brighter spots, we should point this out as well, where we really saw some stronger numbers was in the eCloud, or rather the cloud division. We saw profit there jumping more than 150%, sales were higher, and that is really the story of stronger AI spending that we're seeing globally, really. Overall, though, as you said, numbers not what analysts have been expecting or really wanting to see, though there is room for the company to continue its share buyback program. So that's something else that could be overall a more positive factor for the stock.
Perhaps a little bit more solid results from JD.com?
This did look brighter, and it certainly did post a big beat on what Wall Street had been expecting here. And you saw the reaction to that because we saw ADRs, for instance, climbing more than 4%. Some analysts we've spoken to as well, they point to some healthier margins for the company, so that's a positive because JD.com, like its peer PDD in particular, has really been spending aggressively to try and attract or retain its market share. So in the latest reporting period, for instance, this was a time where it rolled out what's called the JD Super 18 sale. Super 18 because it means on the 18th of every month, JD is going to be offering products like Bulgari perfume, Quattro Motas, our popular liquor brand, those products at 18 yuan per unit. That's extremely cheap. Obviously, it's going to be driving greater user traffic. There's also the potential for greater economies of scale, but JD.com is going to need to know how to monetize that because sales were actually only up around 1.2% in this period, so just slightly ahead of plan. That is a slight concern that, again, analysts have been pointing to in these latest results.
Tech reporter Annabelle Drewell is there. Australia's ASX has announced a full-year profit that beat estimates, but it faces a difficult year ahead, fighting that lawsuit from the country's financial services regulator. Bloomberg's Paul Allen joins us now for more. So, somewhat overshadowed by the news of this week.
It is a bit, but the headline number was pretty good, 474 million Aussie dollars net income. That was a narrow beat. That's about 313 million US. The final dividend, $1.06 Aussie as well. And the ASX sounding an upbeat note in terms of IPO activity as well, saying it's starting to see a return of that. Going forward, sees capex holding steady and expenses rising 6 to 9%. And one can't help but wonder if that might have something to do with the lawsuit that got announced from the regulator ASIC this week. This is, of course, over misleading statements relating to the upgrade of the clearing and settlement system. That had been going on for years. It was first announced in 2015. There were very optimistic updates about it in 2022 before it finally got abandoned. Now, the ASX has already taken $250 million worth of write-downs over that. The penalty, it could be more than $500 million if ASIC wins this case. That notwithstanding, not mentioned in today's results announcement, shares are up 3.1% year to date, but still underperforms the broader index.
We also heard from National Australia Bank with their trading update. Key takeaways there?
1.75 billion was the unaudited cash profit for the quarter, and because it's a trading update, we don't really have a comparable figure to put that up against. But the bank does say net interest margins are stable. Costs expected to be lower than 2023. The Tier 1 capital ratio is still in good shape as well. And home lending is up as well over the quarter. But within it, there was a warning from the CEO, Andrew Irvin. He's talking about the economic challenges that customers are facing. This is something Commonwealth Bank alluded to earlier in the week as well. So he says most customers are proving resilient, but not unexpectedly, we've seen asset quality deteriorate further. And of course, the bank's very sensitive to the rates environment, and we're going to be hearing from the RBA governor later today.
Yeah, very interesting, given that there's some sort of relief that maybe the so-called mortgage cliff hasn't actually eventuated, but clearly there's some vulnerabilities there in the numbers. Bloomberg's Paul Allen there, and we do have much more ahead on the Asia Trade. This is Bloomberg.
China's central bank chief has pledged further steps to support his nation's economic recovery, while cautioning that it won't be adopting, quote, drastic measures. For more, our China correspondent Mingmin Lo joins us in Hong Kong. Mingmin, of course, a lot of concerns always about what Beijing can do, but what exactly did the PBOC governor say?
Yeah, the governor, Pan Gongsheng, he gave an interview to state media and he made some rather ambiguous comments. He talked about the need to maintain policy stability and patience, that there shouldn't be drastic easing or drastic tightening. Now, obviously, the state of the Chinese economy now doesn't warrant any drastic tightening, given the rather lackluster economic data that we saw yesterday. Slight rebound in retail sales, but that was from a very low base in June, and an unexpected decline in fixed asset investment as well. We know the PBOC yesterday, they had delayed the MLF rate announcement to August 26, but we don't expect them to cut rates so soon after they just cut it a few weeks ago in late July. And the PBOC is also trying to de-emphasize this quantitative target as well, like the MLF. The PBOC chief had reiterated that in his interview. And our Bloomberg economics team is expecting a rate cut in the fourth quarter, but increasingly after the data yesterday, more economists are expecting maybe the PBOC could cut rates maybe 20, even 30 basis points later this year, given markets are pricing in more cuts from the Fed. And of course, it depends on the trajectory of the Chinese economy as well. Now, the PBOC governor also said that prices, that they should promote price recovery, which suggests they're paying attention to this persistent deflationary pressure in the economy that is causing companies to scale back their investment and households to scale back on spending as well amid these fears around income growth. He touched on the property sector but did not allude to any new measures. Instead, he reiterated the existing 300 billion yuan in relending facility and said that, look, the current down payment ratios are already very low at about 15%, and interest rates are also very low. But bear in mind that relending facility only has a utilization rate of 4% so far, which suggests banks are still very reluctant to expose themselves to the property sector. And the PBOC governor also said that they will take more steps in accordance with the State Council, and they will have a more supportive monetary policy, as they always said. But again, no further details on what those steps could mean.
Bloomberg's China correspondent Mingmin Lo there. We do have much more ahead on the Asia Trade. This is Bloomberg.
Take a look at how commodities are trading at the moment. We are seeing oil under a little bit of pressure after gaining on the Wall Street session. Of course, we continue to see fears about demand globally, which is also rattling the iron ore space, because we have now heard from China's top steel maker warning that the industry is facing a crisis more severe than the downturns of 2008 and 2015. Iron ore at the lowest level since 2022, although a little bit of upside in the Singapore trading session, as we can see right there. But really, those concerns about demand in China not rattling the copper space. Copper prices have been on the rise. And this, of course, as we continue to see this strike at BHP's Escondida mine in Chile. It's entered a third day, extending a stoppage at the world's biggest copper operation. For more, let's bring in senior commodities reporter James Atwood. James, so where do we go from here? What could potentially lead to a breakthrough? What are you watching?
Well, as you say, we're in the third day. It's early stages. There was a strike at the same mine back in 2017 that lasted 44 days. So if that's any gauge, we've got a long way to go. For now, the two sides, the BHP and the union leaders, are in discussions right now as we speak. In fact, trying to figure out if they can agree to conditions to resume negotiations. So it gives you some indication that there is some interest in getting a deal done, but there's plenty of ground to cover.
What do we know about the current sort of situation where things stand between the two sides?
Well, it seems like there was quite a bit of progress made in the regular negotiation, the collective bargaining, which ended on Monday. It seems the sticking points are around a big signing bonus that the company will give each worker. Right now, the company told us that they'd offered as much as about $29,000 each to sign the new 3-year agreement, plus improvements in benefits. I mean, the companies are looking to contain their fixed costs, so the actual wage increases isn't a big part of it, as I understand. But the real focus is on those bonuses. Now, the union is looking for a share of the profit. They've seen copper prices surge up to record levels in May, although they've come down quite a bit since then. But again, you're looking at the union trying to get their share of the bonanza, and BHP trying to keep those costs in check in an inflationary environment, and also an industry that needs big capital expenditures.
And James, we actually saw the commodity space, copper prices gaining because of the news. So tell us about the magnitude of this stoppage, how long it could go on for. Do we have any precedent of these sort of strikes and negotiations in the past? And how big is this Escondida mine in the global scale?
Yeah, it's a massive mine. It's the world's biggest copper mine, by far. In fact, it produces about 1.1 million tonnes a year of copper. And that compares to the next biggest, which would be Grasberg, which produces less than 800,000 tonnes. So you can see it's a massive operation. It makes up about 5% of the world's mined copper. And so, at a time when there are some concerns about over-demand, this supply disruption can be a fairly sizable offset. We've seen prices come up today, or overnight, and there has been some impact, although analysts, traders tell us that it will take a couple of weeks before the market really gets worried about this. So if they can reach an agreement within the next days and weeks, then it shouldn't be a major problem. If it goes beyond that, it will be. And as you say, there is precedent here. In Chile, these collective bargaining processes, usually there's a lot of brinkmanship and last-minute deals. But in the case of Escondida, there has been some fairly lengthy disruptions, including a 44-day strike in 2017 that really rattled the copper market.
Senior commodities reporter James Atwood there in Santiago. Some of the other stories that we're following: Ukrainian forces say they've accepted the surrender of the largest single group of Russian soldiers since the start of the war over 2 years ago. Our source says 102 Russian servicemen were taken as prisoners of war on Wednesday in the Kursk region. Kyiv claims its military is continuing to expand its cross-border incursion, and that Russian officials have already contacted them about a possible prisoner swap. The US has ruled that Australia and the UK meet a key requirement to increase the trade of weapons under the AUKUS partnership. The Biden administration has agreed the allies have export control systems comparable to that of the US. The finding removes a key point of contention over the alliance with the defence industry and members of Congress. Former Thai leader Thaksin Shinawat's daughter looks set to become the country's next Prime Minister. 37-year-old Paetongtarn Shinawat will contest a parliamentary vote on Friday. She's a nominee of a coalition of 11 groups led by Thaksin's Thai Party. A court this week had dismissed the Prime Minister, Shweta Thavisin, over an ethics violation, Sherry.
And Heidi, Indonesia getting a new capital city, moving its administrative headquarters to Nusantara from Jakarta. The inauguration is scheduled for Saturday after President Joko Widodo's final State of the Union address later today. Bloomberg's Avril Hong takes a look at the new city's progress.
Carved out of the jungles of Borneo, Indonesia's future capital, Nusantara. It's located around 1,200 kilometers from the current capital, Jakarta. An ambitious project spearheaded by Indonesian President Joko Widodo. It's funded by a mix of government and private spending. Construction for the massive project began in 2022 at an estimated cost of $35 billion, with reports of massive cost overruns. The aim? To build a futuristic green city in place of overcrowded Jakarta, a capital that's rapidly sinking into the sea. About 40% of Jakarta sits below sea level, and its coastal areas are under constant threat of flooding. This causes about $6 million of losses each year. Productivity losses from traffic gridlock are estimated at $7 billion a year. Though it's being inaugurated this month, Nusantara is not scheduled for completion until 2045. Satellite images in the past few years show the development of the area. But on the ground, missed deadlines and sudden resignations of top officials plague the project. During a recent trip to Nusantara, Jokowi stressed that building a new capital is not a job that takes 1 or 2 years.
We came here to check the latest progress of the Ibu Kota Nusantara, especially the construction of the palace. I see everything is still in process.
President-elect Prabowo Subianto has pledged to continue development of the city. Yet his manifesto makes clear he'll focus on his own policies, casting some doubt on Jokowi's legacy project, even as he prepares for his final State of the Nation. Avril Hong, Bloomberg News, Singapore.
Take a look at what we're seeing when it comes to the testimony we're getting from RBA Governor Michelle Bullock at the moment, saying that the board at this point thinks it's too premature to be thinking about rate cuts. And that's really critical. We did expect this kind of reinforcement of the pushback on rate cut expectations, particularly in light of those favourable labour market numbers that we had out just yesterday. Michelle Bullock doesn't expect to be able to cut rates in the near term. We're seeing that unwinding of market bets when it comes to a December cut expectation, certainly at about 80% at this point. The RBA board assesses policy as being sufficiently restrictive for now. They're not in a position to cut rates in the near term, but that the economic outlook remains highly uncertain. Michelle Bullock really reinforcing that the underlying inflation view remains elevated, remains too high, but they're committed to be driven by the data. Again, saying that it is premature to think about rate cuts. The balance currently is correct between inflation and what we're seeing in the jobs picture. This is a statement to the Parliamentary Committee. Michelle Bullock saying that they've been making further progress on inflation, but that it has been very slow. They remain focused on that upside inflation risk. Of course, there are still downside risks given some of the weakness that we see across domestic data, but also seeing some of the weakness when it comes to its major trading partner here in Australia, when it comes to China. Take a look at the iron ore story, for example. We saw that big plunge, iron ore hitting the lowest since 2022. The domestic steel crisis in China continuing to rattle the market. We're still seeing quite a bit of downside when it comes to Singapore trading at the moment. Futures at one point dropping below $94. We heard from Shane Oliver potentially talking about $80. Chinese steelmakers really reducing production and talking about this long, harsh winter to come. Sticking with commodities and also under some pressure is lithium. Of course, this has been the key metal for electric vehicle batteries and so part of the energy transition narrative. Sigma Lithium produces low-carbon, high-purity lithium concentrates. And joining us now from Sao Paulo is their CEO, co-chair and co-founder, Ana Cabral. Ana, really great to have you with us. So we've been talking about some of the pressures coming more broadly across the commodities complex. How do you view lithium margins in particular, given that we have seen that downside in prices for this asset as well?
Well, thank you for hosting me, Heidi. Margins are a function of how well you manage your costs. Given that you don't control prices, cost control, low cost, operational efficiency is the main driver for margins. The market is there, the price is a given, so the ability to manage operational efficiency and to operate in a low-cost environment, such as what we have here in Brazil, I would say today is the main source of commercial competitiveness and overall corporate competitiveness in this industry.
I wanted to talk about some of the interest, historically renewed in Sigma. And we know that there were takeover talks that were reportedly being held with BYD. We know that there's been overtures of interest from the likes of Tesla and VW. Where are you seeing interest? Is there sort of any compelling argument for you to sell at this point, or do you prefer a different type of partnership model?
Oh, not at all. We're definitely not selling. We're builders, right? So I think what we've achieved over the last year, operating this company with maximum standards of global efficiency, has demonstrated that we can operate basically with world-class parameters as well and or perhaps better than some of the best operators in this industry. Case in point, just a week ago, we achieved 0 accidents, 0 fatalities. We were catapulted to the 2nd place in the ICMM rankings, basically like a seasoned producer would be. More importantly, we continue to show cost reductions and margin increases, even despite the challenging environment for lithium prices. So we've done quite well. We're expanding capacity, we're doubling capacity. So we'll be here for quite some time, perhaps 2 to 5 years. What's fantastic, though, is that just yesterday, our neighbor, which is a pre-operational company, I think I would say 2 to 3 years away from production, was acquired by Pilbara, which is one of the largest companies in the sector based in Australia, which further demonstrates the strength of Brazil as a competitive lithium producer territory. So it's fantastic to be able to welcome to Brazil and, more importantly, to be flag bearing for this emerging Lithium Valley territory in Brazil. So we're here, we love it here, and we'll continue to operate here.
Right. In that sense, though, does that also increase competition in the space?
Well, not at all, because ultimately what's happening is a migration to low-cost environments where there's a huge adherence to high traceability standards. So it's a very positive movement for the industry where there's a gravitation to an environment such as Brazil, where there's green energy, legal certainty, fantastic operational infrastructure, given that it's a mining country, mining territory, with a low-cost all-around environment. So I would say the industry is preparing itself to become more and more resilient, which is what we are, what we've always been, but other players are joining in on the resilience push, given the all-around lithium market price environment, which none of us control. So I would say it's a very welcome movement.
At the same time, something that you don't control is really, as well, the geopolitical tensions arising at that center of critical minerals, of really commodities that the likes of China, the likes of the United States want for their transition to the green energy sector. What does that mean in terms for your business? How do you really balance that out?
Well, Sherry, we couldn't be better placed given what's going around in the world. Brazil is a non-aligned country. It's a very good friend of the United States. It's a very good friend of China, equally friends with both. We take the same position as the country we are operating, which means we're agnostic as far as both sides of this situation. So, again, it doesn't affect the way we conduct our business at all. In fact, we are actually doing quite well, given that we actually replicate the country's non-aligned position. We sell pretty much half of our production to China and the other half to what we call the Western related countries. We just shipped a boat to Japan just today. So the boat's been ready since Monday. The month before, we shipped a boat to China. The month before that, we shipped to South Korea. So as you can tell, I mean, we're globally diversified in terms of the geography, and we're fairly agnostic. And we believe that this non-aligned position for Brazil allows the country to benefit from everything, from just everything, given that we're receiving investments from all sides of the aisle: Europeans, Japanese, South Koreans, North Americans, Chinese, I mean, they're all clients. So that's how we see them all.
You mentioned interest from all around the world. You mentioned Pilbara also getting into Brazil as well. The business environment in developing countries like Brazil can be a bit challenging sometimes. How do you see that, and how do you really try to assure investors that their capital is being well used?
Well, that's quite the contrary. I mean, Brazil is basically hosts the largest global producer of iron ore. He hosts the largest global producer of niobium. So Brazil is quite unique, as it's got the highest environmental standards, the cleanest electricity grid in the world, one of the lowest costs in the world, though, because it is an emerging market, so average salaries here are naturally lower than elsewhere, but with a legal infrastructure, with commercial rule of law, with a mining code that's been established for decades. So the Pilbara acquisition of my neighbor just comes to underwrite that and basically subscribe to how Brazil is an incredible country to essentially industrialize, because we industrialize the materials, right? Lithium materials with the lowest possible carbon footprint and highest possible sustainability standards. I'm not sure if you realize, but we're the only zero carbon producer in the entire industry. We call quintuple zero lithium. So we produce the most sustainable lithium in the world here in Brazil, which is a fantastic accomplishment.
Ana Cabral, really good to have you with us of Sigma Lithium. We do have more ahead on the Asia trade. This is Bloomberg.
Israel has begun talks with international mediators about a proposed pause to the war in Gaza. The move is an effort to ease tensions between Israel and Iran. For more, let's bring our Asia senior editor, Bill Ferries. So these peace talks in Qatar, it feels like expectations for deliverables are so low going into this.
Yeah, they really are. I mean, of course, this was the first day of these renewed talks. There was no real breakthrough. If you were looking for a silver lining on the situation at this point, I think it's that the negotiators have agreed to resume talks Friday in the Middle East. So they've just kind of shut those down on Thursday there. But, you know, the sticking points are the same ones that we've been talking about for several months now. And at its core, it really boils down to whether, after perhaps a 6-week pause in fighting, whether Israel would resume the fighting or whether, as Hamas is requesting, it basically turns into a permanent ceasefire and Israeli troops leave. Israel, of course, have said they want to eliminate Hamas's leadership and everyone involved in that October 7th attack on their territory. And until that happens, I don't think it's likely that they're going to let up in the fight.
And Bill, of course, we have seen those images as we're showing right now of the tragedy, the devastation, but how extensive is right now really the fallout from the war, and what would it take to clean up and rebuild?
Yeah, so it's a powerful big take story out on the terminal on the web today. The costs are, you know, it depends on which part of the cleanup and reconstruction you're talking about. There's an estimated 42 million tons of debris that would have to be cleaned up and disposed of. Just for comparison's sake, if you put all of that into garbage trucks, it's a line that would stretch from New York all the way to Singapore. So just a massive reconstruction effort, unlike anything that we've seen in any previous conflict in that area. Just removing the debris estimated at about $700 million. But when you're talking about the complete reconstruction, you know, the rebuilding of hospitals, of roads, of infrastructure, of cleaning up the agricultural land for, you know, decades to come, you're talking about up to $80 billion in some estimates. And obviously real question marks about who would foot that bill, who would pay it, what kind of an economy Gaza would even have at that point. So a very pessimistic, grim outlook for the Gaza Strip, even if you can get the warring parties to step back.
For Asia, senior editor Bill Fair is there with the latest from what's happening in Gaza. And subscribers can actually read that story on the Big Take on the terminal. NI Big Take is the function, or you can head over to Bloomberg.com as well. We have more ahead on the Asia trade. This is Bloomberg. It's raining here in Tokyo and it looks pretty grim outside. Look at that picture. Typhoon Ampel edging closer to the island of Honshu is really getting closer. Major Japanese airlines had to cancel flights. The government has issued warnings against possible landslides and flooding. And Heidi, I was supposed to head over to South Korea today because we'll be live from Seoul next week. Of course, we do have the Bank of Korea decision next week as well as other interviews coming up. But my flight was delayed and I'm not quite sure when I'll be able to get there.
Safety first, Sherry. I just hope that you can have that safe flight and land with no weather disruptions in Seoul. Watching out for that typhoon as it approaches Japan, of course. But otherwise, we're looking like kind of pretty clear skies when it comes to these markets this Friday, though. The market opens in Sydney, Seoul are almost upon us in the next few minutes, and we are seeing a little bit of upside there. US recession fears are fading. We had that positive read on the labour market here in Australia as well. So equities primed for gains at the open. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. After another session of gains on Wall Street, we had more benign economic data, including retail sales that beat estimates. Not to mention initial jobless claims also fell for a second week, Heidi.
Yeah, all of this ahead of Jackson Hole, right? We'll be listening very closely to what Fed Chair Powell has to say at the Economic Symposium. Elsewhere, though, we're also seeing that pushback, as expected, from the RBA Governor, Michelle Bullock, against any kind of imminent easing opportunity, given the labour market numbers came in so strong yesterday. We're also watching China because it doesn't look like the PBOC is going to pull out any big drastic policy steps, despite, of course, the data from property to domestic activity indicators continuing to languish.
Yeah, a lot for investors to digest on this Friday, but take a look at the open on the Nikkei, up more than 1.5% for the Nikkei and the topics right now. Of course, it's a very rainy day here because we do have a typhoon approaching the mainland in Japan, but we are seeing those strong gains when it comes to the Japanese equity markets. For a fifth consecutive session now, of course, we have seen that incredible rebound, and we're at around the highest levels since the beginning of the month. But the Japanese yen also holding steady. We saw a little bit of weakening in the previous session overnight, given a little bit of strength on the U.S. dollar from rising treasury yields. We continue to watch whatever indications we can get from the government of what the BOJ will do. The finance minister, Shunichi Suzuki, saying that monetary policy should be left to the BOJ. Take a look at how Korea is coming online. Back from a holiday, we had seen the Korean won weakening for the first time in 3 sessions this week. We're seeing a little bit of strength in the early morning session here on Friday. 1364 is the level, while the Kospi is now playing some catch up to those gains that it missed out on yesterday. The Kosdaq is up more than 1.5%, Heidi.
Sherry, we're still monitoring some of the commentary coming through from the Reserve Bank of Australia. And interesting, we did also, in addition to Michelle Bullock, heard from the Deputy Governor, the Assistant Governor, Christopher Kent, who, of course, whose oversight includes financial markets, and saying that markets have calmed, but there will be some bouts of volatility. But take a look at what we're watching when it comes to trading in this part of the world. That staggered session coming online about 0.3% higher. We did see Aussie equities performing quite well in the previous session and really being supported by, of course, the more robust labour market numbers and some resilience, at least when it comes to jobs in this economy where we have seen some degree of weakness elsewhere. The Aussie dollar is holding steady at 66.13, a little bit of upside, but we could see further lift there as the hawkishness that we're still getting from the RBA become sort of a little bit more able to get traction, right, as we had the US data sort of cooling off a little bit there as well. Let's bring our next guest, who says the possibility of a US recession is still real. Selectivity is key. With us now is Vikas Prashad, who's an Asian equities portfolio manager at M&G Investments. Because when you take, I guess, as a whole, the recent lot of US data that we've had, how do you assess the risk now?
Well, good morning, and it's great to be back. The risk that I mentioned of a U.S. recession has been there. It is there. It's been there. Maybe the probability feels a little bit higher than it had been. What we see in the most recent data is that the labor market yet hasn't weakened very much. The inflation data are encouraging for the most part and heading towards the Fed target of about 2%. It seems like we're going to get there later this year. When you dig into the data, there are some things to pay attention to. For example, if you look at the size of the auto sector, and the fact that new car sales are down so much, or the prices are down so much, used car sales down so much, given the ramifications for that sector and the trends there in Asia, in semiconductors, in the various kinds of chips and the automotive parts sector, that's something that we're watching. But for the most part, the data last night were encouraging.
There's not much that's encouraging out of China at the moment when it comes to, the trajectory of this economic slowdown, nor the willingness of policymakers to kind of go in for a big bang easing. Does that mean that there are no opportunities, though? Are you constructive on any sort of selective sectors or stocks within China?
Well, in China, yes. I'm glad we're starting there. For 3 years now, we've been negative. We have been cautious underweight on the mega-cap China tech sector. Given the consistent underperformance there, and what we are seeing is perhaps a stabilization, even perhaps an improving of earnings expectations there, we're finally spending time on that sector again. We remain underweight. There are plenty of other opportunities to look at in China. The domestic consumer-facing Chinese companies, for one, if you look at the recent change at Starbucks in the U.S., the executive change, I think that the strategy that they have followed in Asia, or the lack of success that they have had in Asia, and China in particular, I think that has driven that. That is a direct result of the strength and the progress that we have seen in the domestic Chinese companies. So that side of the market we're spending more time on. Factory automation we have talked about before. The Chinese semiconductor industry we have talked about before. The EV supply chain, broadly defined, not the OEMs, but the supply chain for that. Not OEMs and not batteries, I should add. There are plenty of opportunities there also. Aside from the mega-cap Chinese tech names, we are spending less time on property and on banks as well. But there's plenty to look at in China.
I was going to ask, is the property sector still a no-go? Because we saw those numbers when it comes to China's fixed asset investments unexpectedly slowing. We have heard from the steel manufacturers also slashing their output for this year. Is there no really silver lining at this point for the property slump?
Well, we're looking for it. We don't see it yet. And we continue to look forward for it. And we don't look at it just in the Chinese data. If we look at Japanese exporters that supply the heavy machinery, that supply the equipment and the commodities to this, and the Aussie data as well, we don't see that silver lining yet, but we continue to look for it.
I like in your notes that you talk about South Korea being an underappreciated market. Right now, we're getting lines that the Kospi has now recouped most of the losses that we saw since last week's sell-off on August 5th. Why do you think investors are now so interested in this market, especially if we continue to see the optimism about the tech sector, chips, semiconductor exports?
I think there are two reasons for this. The first reason is that Korea seems to be viewed as a narrow market, that it's all about semis and perhaps car manufacturing. We view it as a much broader and deeper market than that. There are domestic consumer names that we have interest in, there are financials that we have interest in, and of course the tech supply chain, tech hardware and tech software. And the automotive sector as well. So it's a pretty broad and deep market. That's number one. That one misperception that we don't have. The second is that there's skepticism about the Korea Value Up program. We believe that for many reasons, including demographics, this has to work and that it will work. the pace of adoption probably won't take as long as it did in Japan, and the results probably will be in line with, perhaps if not greater than, what we have seen in Japan thus far.
For Japan, we've seen that market kind of regain its footing after the terrible sell-off, right? Are you seeing sort of more interest now, the sort of resurgence of foreign buyers? What sort of opportunities, I guess, in this stage would you be looking at for Japan?
Well, in Japan, this is a market that we have been constructive on for years. We remain constructive on it. It is probably not in as early of an innings as India is in the long-term equity appreciation cycle, but it's still pretty early. Last Monday was a gift for long-term investors. In the first half of the year, we were quite underweight tech hardware in Japan. We used last Monday and Tuesday and Wednesday to reduce those underweights. In the tech supply chain, we remain overweight on the memory side and on the foundry side. But in tech hardware in Japan, slightly underweight still, but much less underweight than we were 2-3 weeks ago. But that's not the only set of opportunities that we see. We see it in financials. We see it in consumer names, in small caps also across sectors. There are plenty of opportunities in Japan, and the recent sell-off and the reset in valuations was quite helpful. We think that the worst is behind us, at least in the near term for Japan.
Vikas Prasad, good to have you with us, Asian Equities Portfolio Manager at M&G Investments. Again, take a look at what the Kospi is doing right now, because it's now recouping all of those losses that we saw last week on the August 5th sell-off. And take a look at that dramatic comeback for the market after coming back from a holiday as well. Now gaining for a fifth session, the longest winning streak since December 2023. We had really more economic data on the upside for South Korea, including that surprise tightening in the job market, with the unemployment rate declining to the lowest level since October. That gives a little bit more time for the Bank of Korea to hold rates steady before really moving, perhaps later in the year, in October, as some people are saying. We do have the BOK rate decision next week. The Asia Trade will be there in Seoul, broadcasting live. This is Bloomberg. Take a look at how Chinese tech ADRs closed on the Wall Street session. A little bit of divergence you can see there, with earnings beats coming from Tencent and JD.com, and those strong gains being felt. But Alibaba really unchanged after posting an anemic 4% rise in revenue. This after its commerce business shrank for the first time in at least a year. Let's bring in our tech reporter, Annabelle Drewlers. Belle, so mixed trends across businesses for Alibaba. What were the key takeaways?
Yeah, well, you highlighted some of them there, Sherry, but as you said, overall revenue up 4%, but the profit was down 27% in the period. And that just really points to how much Alibaba is continuing to grapple with challenges in its e-commerce division. E-commerce division from two different fronts here. Firstly, you've got concerns around the Chinese consumer. Yes, we saw retail sales a little bit brighter yesterday, but overall, Chinese consumers are not reaching into their wallets. And if they are not pulling out as much cash as before. And then you can also add to that the competitive landscape within China. And Alibaba faces very stiff competition here. So we did see it also trying to attract and retain its market share. That had a bearing on its margins in the period, because they dropped down to 15% operating margin. That was 18% in the year earlier. Brighter spots, of course, to note, we saw strength coming through in the cloud division in particular. So we saw profit jump of around 150% there. Really tells that story of how much companies are continuing to invest in AI outlay or AI spending. But overall, as you say, numbers not what analysts have been really wanting to see, even though there is enough room for the company to pursue its share buyback program. And we have seen Alibaba really buying back a lot of stock over the course of this year.
Annabelle, and investors reacted pretty positively to JD.com. What did we see?
yes, this was a bit of a different story here because, again, looking at those e-commerce divisions in particular, whilst you saw the Taobao Tmall revenue decline of around 1.4%, actually JD.com's retail gain was around 1.5%. So it seems like JD.com could be doing a better job of monetizing those different revenue streams, like live streaming, for instance. Though we do know that JD.com is really spending aggressively here in that space. So, for instance, in the latest period, they launched what's called the JD Super 18 sale. Super 18 because it means that every single month on the 18th, they're going to be offering luxury products like Kweicha Moutai, for instance, a popular liquor brand, Bulgari perfume, for instance, for 18 yuan per unit. Again, that's about driving greater user traffic. JD.com might be able to get better economies of scale out of that, but they do need to continue monetizing going forward. And that's something else that analysts have been pointing to in these results. Although, as you said, a strong profit beat, and we saw the ADRs climbing 4%.
Tech reporter Annabelle Droll is there with the latest. Let's take a look at some of the movers that we're watching. We're just about 15 minutes or so into the start of trading this Friday session here in Australia, and looking like some broader upside when it comes to the broader ASX just continuing on that trajectory that we saw in the rally yesterday. But take a look at some specific sort of idiosyncratic names. So we're watching BHP. We're still sort of in the thick of things when it comes to these attempts to resume negotiations with workers at its Chilean copper mine. They're striking Chilean miners as well as BHP Group, really making another stab to resume these negotiations in the wage dispute. We heard about a mediated session between the two sides and labour authorities on Thursday, but still looking to see whether we'll see any success. It was that unsuccessful attempt in the middle of the week to restart talks, but the two sides were just too far apart. Watching ASX as well, we're down by just about 1.5% when it comes to this stock, and of course we did get the numbers. We'll get a little bit more on that in just a moment, but that's really been overshadowed by some of its upcoming legal woes with that ASIC lawsuit very much in focus. Paul Allen joins us now with more details, and let's start off with the numbers, because obviously so much of this has been about the sort of allegations of misleading statements from the ASX this week.
Well, you're quite right. The headline for the past year was pretty good. 474 million Australian dollars, about 313 million US. That was a beat. The dividend, $1.06, was also not too bad. And the ASX saying it's seeing a return of IPO activity as well, which has been pretty sluggish in Australia. As for the outlook, it does see expenses rising at 6 to 9%. And yes, one can't help but wonder if perhaps that's connected to the developments we had this week. Of course, the ASX being sued by the regulator ASIC for making misleading statements over the upgrade of its clearing and settlement system. That saga dragged on for a very long time, and without getting into the nuts and bolts of it, if successful, this lawsuit could end up costing the ASX more than $500 million. They've already taken $250 million in terms of write-downs on that failed upgrade. So shares are up 3.1% year to date. They're down today, but ASX has been underperforming the broader index.
We also had a trading update from National Australia Bank.
Yeah, that's right. Hard to get a read on things here because there's no comparative period. It's just the third quarter trading update. Unaudited cash profit, $1.75 billion. That's about $1.1 billion US. Everything looks to be ticking along nicely. The net interest margin is stable. The Tier 1 capital ratio is still really strong at 12.6%. Home lending rose as well, 1% over the third quarter. But we did get a warning from the CEO, Andrew Irving, saying that the economic environment is challenging for customers. Of course, Australia grappling with the cost of living problems, as is much of the developed world, and he noted that non-performing loans have been rising, but he says customers have been proving resilient, but not unexpectedly asset quality has been deteriorating for NAB.
Bloomberg's Paul Allen there. Take a look at what we're watching when it comes to Australian bonds as we continue to monitor some of the commentary coming from the parliamentary testimony for Michelle Bullock and some of her senior leadership at the RBA. This is what we're watching as, of course, we had that yield curve really shifting higher, that 13-month low when it comes to yields on these sort of increasing bets that the RBA may potentially break. But we are seeing that unwinding of that trade, though, a little bit, particularly when it comes to, say, December expectations of a rate cut, this pushback that we've seen this morning, largely unsurprising from Michelle Bullock, saying that really there's this conversation about thinking about rate cuts is taking place in a very premature way, that the board remains vigilant to the upside risks to inflation. It is premature to be thinking about rate cuts. So watching for sort of the reaction to that, particularly in light of the RBNZ's sooner than expected move to cut rates. We're now hearing from the Assistant Governor, Sarah Hunter, speaking in her part of the testimony, saying it's too early to say whether tax cuts are being saved or spent. That when it comes to the price-setting behaviour in particular has been important for the broader OCR path. Michelle Bullock saying that a large chunk of higher public demand is coming from the activity that we've seen in the States as well, but certainly steady as she goes, and there's certainly no indication that the events of the past week, and certainly this is being reinforced by the strength that we saw in the labour market numbers, to be able to enable the RBA to really stick to what has been a very hawkish bias. More ahead on the Asia trade, this is Bloomberg.
Former Thai leader Thaksin Shinawat's daughter looks set to become the country's next prime minister. Paetongtarn Shinawat will contest a parliamentary vote today. Bloomberg's Avril Hong has the details from us from Singapore. So what exactly is going on?
Well, we saw late yesterday Paetongtarn Shinawat, the youngest child of Thaksin Shinawat, of course, is the former Thai Prime Minister, managing to secure the nomination from the 11-member coalition. And this is a coalition that has about 300 seats in the 500-seat House of Representatives. We're going to see later today her contesting of this parliamentary vote. And if she's successful, she could be Thailand's youngest ever Prime Minister at 37 years of age. And of course, this was all triggered by Srettha Thavisin, the Prime Minister, formerly getting ousted, disqualified after a constitutional court found him guilty of ethics violation. We're also seeing some focus on how, she has been a key figure as part of the Shinawat business empire. So there's some hope that, she can bring that to the table if she is indeed securing the prime ministership going forward.
Are there concerns about political instability at this point?
I think there are still some of these risks. I mean, she's just the latest face of the influential Shinawat clan in politics. And while they are heavily influencing the Thai political scene, we've also seen their key players routinely getting booted out of Thai politics. For now, at least, what is really interesting is the speed in which she secured the nomination from the 11-member coalition after the ousting of Srettha Thavisin just on Wednesday. Late yesterday is when we saw her actually securing that. So to some, that signals that, the 11-member coalition as well as the Pheu Thai party's pact with the pro-royalist establishment is at least intact for now.
Do we have any ideas of what economic policies she could pursue?
Well, it looks like it's going to be a policy continuity that we'll see if she is indeed successful as becoming Prime Minister. We have already the former government pursuing some of these looser fiscal policies, so we could see that continuation of that. Of course, this was the government that repeatedly clashed with the Bank of Thailand. One of the things that we're watching really closely is the fate of a $14 billion digital wallet, and this is a plan to give cash to adult Thais, about 10,000 baht or roughly $280 to stimulate the economy. And as recently as yesterday, we heard from the caretaker Prime Minister that they would push ahead with such plans. But Paetongtarn has also said that once, the Prime Minister vote is over, that she would review this. So this is something that we're keeping an eye on as well. Sherry.
Avril Hong there joining us from Singapore. And of course, we continue to watch also the leadership race here in Japan after Prime Minister Kishida announced, Heidi, that he would not be running for a second term. We're now expecting that vote to come late September when it comes to the president of the ruling Liberal Democratic Party. We want to know about their economic policies, right? When it came to the digital minister, Taro Kono, I spoke to him just a few weeks ago and he mentioned how he wanted to see the Bank of Japan raise rates given the weakness of the Japanese yen. He's seen as a contender. We're also seen as a contender there on the right side. Motegi Toshimitsu, the Secretary General of the Liberal Democratic Party, we have heard him talk about the BOJ having to articulate its plans to normalize policy more clearly in order to support the yen. So when we heard about Kishida not running, Heidi, there was a little bit of strength in the Japanese yen that perhaps if some of these candidates actually do win that presidency, we could see some policies veer towards that.
Yeah, in fact, one of the candidates, Takaichi's view on the BOJ is particularly interesting, and this comes from the economic security minister, repeatedly emphasising she's done so when it comes to the role of monetary easing to support the economy. This is even in her latest policy manifesto on her website. So that's another potential sort of candidate in the game for the LDP election who has a very strong view on the role of the Bank of Japan. So that dovishness is also at play there. Very much an outlier, but she has argued for continued monetary easing. At this point, well, sort of that horse is bolted, if you will. But it's pretty interesting as we set up for, the sort of decisions that have to be made and as the race to find a new premier heats up in Japan. More ahead on the Asia trade.
Continue watching.
This is Bloomberg.
We have non-oil domestic exports from Singapore right now. Year-on-year gains of 15.7% for the month of July. That's a huge jump from the contraction of more than 8% that we saw in the previous month. And of course, also the fact that we have been in contraction territory for 5 months already. And this gain is in the double digits for exports year on year. Also, the expectation was also for a gain of only 1%, so that's really huge. When it comes to the month-on-month number, also 12.2% gain for Singapore. Non-oil domestic exports also coming out of contraction territory. Really helped by electronic exports. Look at that, year on year, a jump of 16.5% after a contraction of more than 9%. And really, it had been the electronic sector and the weakness in shipments there that had pressured the Singaporean economy, very open to trade, of course. Right now, we're seeing that huge recovery being led by those electronic exports and non-oil domestic exports year-on-year gain of 15.7%. We have seen significant strength in the Singapore dollar recently, given expectations that the Monetary Authority will keep a tighter policy. We are seeing the upside of about 0.5% in the past 2 days, Heidi.
Take a look at how all of this is sort of playing into what ultimately, Sherry, is proving to be a pretty buoyant day when it comes to Friday trading. We have some semblance of calm returning when it comes to the lowering volatility. Of course, some of the pretty resilient data from the US and also economies like Australia, the labour market numbers still kind of in view, has really added to that. For Australia, we are still hearing from testimony from the RBA's Michelle Bullock and some of her colleagues. The major point seems to be it is still premature to think about rate cuts, despite, of course, its neighbour, the RBA, said embarking on its easing cycle sooner than expected just a few days ago. But we are seeing that broad equities rally. Japan really surging by just about 3% when it comes to trading on the Nikkei 225, really gaining more ground as we saw that GDP recovery inside with the consumer recovery, I should say, inside with those GDP numbers. We're really extending that rally now into what a fifth straight session as we head into the end of the week. That strength in domestic private consumption is really starting to come into the fray a little bit more. We're also seeing a big move when it comes to the Kospi off those session highs of about 2%, but it's really recouped all of its losses since that August 5th sell-off. Sentiment very much improving across the board, and the Kospi is up about 4% this week, which would be the best performance since about early February. A very different picture when it comes to China as we head into the start of trading across Greater China, where the central bank chief, the PBOC head, has pledged further steps to support his nation's economic recovery, but still cautioning it will not be adopting any drastic measures. For more, our China correspondent Min Min Lo joins us now from Hong Kong. So at this point, investors have been screaming for drastic measures for quite some time, but what did we hear from Pan Gongsheng?
Yeah, we are reading between the tea leaves here because his comments were rather ambiguous. He said that China needs to have policy patience, policy stability, that there shouldn't be any drastic easing or policy tightening or drastic tightening. At this moment, of course, China doesn't need any drastic tightening given the weak economic data that we saw coming out yesterday. Yes, there was a bit of a rebound when it comes to retail sales, but that was coming off a very low base in June where we had a big miss there, and there was unexpected decline in fixed asset investment as well for the month of July. And we know the PBOC, for instance, yesterday they had delayed announcing the MLF rate to the 25th of August. Our Bloomberg economics team believes that given that they had just cut rates very recently in an off-schedule cut in late July, they're not expecting any rate cut anytime soon, but we're expecting at least a cut in the fourth quarter. But after those data that came out yesterday, there are more economists calling on the PBOC to cut 20, 30 basis points even towards the end of this year, especially given that the markets are pricing in more cuts from the Fed now. And of course, it still depends on how the economy performs later this year as well. The PBOC governor touched on the need to promote price recovery, which suggests that the government, yes, they are acknowledging this issue around the persistent deflationary pressures in the economy that is causing private companies to pull back on their investment, as we saw from that weak credit growth data that came out a couple of days ago. He also talked about the property sector, but did not allude to any new policy measures. Instead, he reiterated those existing measures, the 300 billion yuan in relending facility, and he said that interest rates are already low, down payment rates are already at record lows. So he said, yes, the PBOC will take some steps in accordance to the State Council, but not really clear what those steps would be.
Tell us a little bit about what the government has been doing so far when it comes to supporting the property sector, given, as you say, that really the property slump has been the focus of policymakers in the last couple of years.
Yeah, I mean, we have seen a mix of supply side and demand side policy. From the demand side, we have seen this rollback of home buying curbs in all the major cities, making it easier for people to buy homes. And then you have the cuts in the down payment ratios, reduction in mortgage rates, for instance. And then on top of that, the supply side, the PBOC had announced a 300 billion yuan in relending facility back in May to encourage state-owned enterprises to buy back those unsold homes on the market. But the problem is right now the take-up rate for that is only 4%. So that means that banks are still very reluctant to be exposed to the property sector given the risk in that area. And our Bloomberg economics team also had estimated that there are 48 million homes that were pre-sold but not yet completed, and it could take 8 years to complete them. So that doesn't, help to increase the appetite for pre-sold homes as well, because consumers would be worried about the completion rate of these homes. Not to mention there is still a lot of completed homes that are also not sold as well. So it takes time to absorb all of that excess inventory on the market. And so far, it looks like the measure so far is just simply not enough to help turn around the sector. We saw the home prices data coming out yesterday. New home prices extending 14th straight month of decline by now. So don't know when the bottom will be when it comes to the housing crisis.
Bloomberg China correspondent Min Min Lo, that has been really the biggest question in the last few years, right? We continue to watch also the stock markets. The Hang Seng Index could be adding more stocks in the healthcare, tech, and logistics sectors in an upcoming quarterly review. That's after including only one extra firm in May. Asia Equities reporter Sang-Mi Cha joins us now in Hong Kong. And Sang-Mi, we have seen a little bit more optimism ahead of the earnings season in Hong Kong. What can we expect in terms of some of those names being floated by analysts?
Yeah, the benchmark right now has 82 constituents, and the whole purpose of the compiler is to make that number to 100 and to make it a more balanced representation of industries. We have been hearing constantly that the most underrepresented industries is the healthcare. So the names that are floated are Innovent Bio, Beijing. These are the stocks that have the highest weightings in that industry. And then also we have some of the EV maker names like XPeng, and also the tech names are being floated like ASMPT that does chip packaging, and also some of the Costco shipping. These are the shippers, the container shippers. So various industries that we are seeing here. And when we look back to February, when they did the quarterly review there, the benchmark was, it stayed unchanged. And also the very last one that we have seen in May, we have seen that they added just one company, BYD Electric. So given that some of the analysts are saying there will be more new joiners this time around, and the whole purpose, of course, is to boost the performance of Hang Seng Index. It's been trailing ever since its May peak we're seeing in the chart, and the whole purpose is to boost these stocks' performance.
What's your team watching out for when it comes to trading in China today?
Right, the onshore stocks actually had the best day in 2 weeks yesterday. We have seen the good data, like some positive data coming in consumer spending for July, and that has boosted the performance. But it remains to be seen whether this rally can continue, because we had a report on how the national team came in and spent about $66 billion buying the ETFs as of yesterday. But it was not enough to prop up the market. When we see the CSI 300, it's down close to 4% year to date. And that contrasts with the HSCI, the gauge that tracks the Chinese stocks listed in Hong Kong, which actually gained about 4%. So it remains to be seen whether the economic downturn and all these pessimism around the Chinese onshore stocks will be resolved in time.
Asia Equities reporter Sang-Mi Cha there. More ahead on the Asia trade. This is Bloomberg.
Take a look at how emerging market currencies across Asia are trading at the moment. A little bit of a mixed picture. Of course, we are watching the Thai baht very closely. We have seen efforts by Thailand to support the stock market with a $4.3 billion initiative. At the same time, we continue to watch those political changes. A new prime minister coming in very soon. We are also watching the ringgit, which is leading the declines against the U.S. dollar. Of course, we are seeing traders paring back those aggressive rate cut bets coming from the Federal Reserve, especially after stronger U.S. retail sales numbers. We're also watching Indonesia very closely, given that we do have Joko Widodo's last State of the Union, last State of the Nation address, not to mention a budget speech later this afternoon as well. Indonesia is getting a new capital city, moving its administrative headquarters to Nusantara from Jakarta. The inauguration is scheduled for Saturday after President Joko Widodo's final State of the Nation address. Bloomberg's Avril Hong takes a look at the new city's progress.
Carved out of the jungles of Borneo, Indonesia's future capital, Nusantara. It's located around 1,200 kilometers from the current capital, Jakarta. An ambitious project spearheaded by Indonesian President Joko Widodo. It's funded by a mix of government and private spending. construction for the massive project began in 2022 at an estimated cost of $35 billion, with reports of massive cost overruns. The aim? To build a futuristic green city in place of overcrowded Jakarta, a capital that's rapidly sinking into the sea. About 40% of Jakarta sits below sea level, and its coastal areas are under constant threat of flooding. This causes about $6 million of losses each year. Productivity losses from traffic gridlock are estimated at $7 billion a year. Though it's being inaugurated this month, Nusantara is not scheduled for completion until 2045. Satellite images in the past few years show the development of the area. But on the ground, missed deadlines and sudden resignations of top officials plague the project. During a recent trip to Nusantara, Jokowi stressed that building a new capital is not a job that takes 1 or 2 years.
We came here to check the latest progress of the Ibu Kota Nusantara, especially the construction of the palace. I see everything is still in process.
President-elect Prabowo Subianto has pledged to continue development of the city. Yet his manifesto makes clear he'll focus on his own policies, casting some doubt on Jokowi's legacy project, even as he prepares for his final State of the Nation. Avril Hong, Bloomberg News, Singapore.
Let's discuss the outlook for Indonesia as we await President Jokowi's final State of the Nation and budget address. With us now is Eve Warburton, Director of the Indonesia Institute at the Australian National University. Eve, great to have you with us. What will you be watching out for as we transition to a new government?
Well, I think that, this year has been a really fascinating year in Indonesian politics. As your report outlined, we have an incoming new President-elect Prabowo Subianto. But the outgoing president, Joko Widodo, or Jokowi, is pretty determined, in fact, to maintain some sort of influence over government moving forward. He, of course, engineered to have his son as Prabowo's vice presidential candidate. So he will be in the vice presidential palace moving forward. And I think all of this really is about, to an extent, Jokowi trying to make sure that he has some influence. And so his legacy projects, and in particular, the new capital, will still have someone there committed to it. Because while Prabowo does indeed, express his commitment to this project again and again publicly, there are lots of challenges ahead for the new capital. Jokowi will be talking about that, no doubt, in his final State of the Nation address. But one of the big problems is actually political. Why is it that we would expect a new president, Prabowo Subianto, to invest heavily in the legacy of his predecessor? And so to an extent, that's what Jokowi is going to be very concerned about moving forward. And that's why I think we can see, to an extent, why he's interested in trying to find ways to maintain power even after he steps down in October.
At the same time, we're expecting the budget shortfall to really close closer to the official limit of 3% of GDP, right? So how do you get around trying to pursue these policies from your predecessor, but also have your own big-ticket items, and how do you pay for all of that?
Exactly. Yeah, that's right. I mean, I think if we look back at the sort of the economic legacy Jokowi leaves, I mean, there are obviously some real positives. He's overseen a decade of economic stability, growth of around, 4 to 5%, which is the envy, in fact, of many countries around the world. But at the fiscal end, Indonesia remains a problem on the revenue side. There always has been. Indonesia is dependent on commodity exports largely. And there's a real sort of problem with tax collection. It's got a really low tax ratio to GDP. And so with this revenue problem, Prabowo now has limited funds to invest in what he wants to be known for, what are his big ticket items. And of course, one of them is going to be very expensive, which is his plan to fund free lunches for school students in many parts of the country. And so this is what he talks mostly about, and this is where he is going to have to try and find new sources of revenue. And it may be that he scrapes some money from what was supposed to be planned for the new capital. We're not sure yet. But I think if he really wants to be able to fund that, to really fund that seriously, the new government is going to have to think about how it can improve its tax ratio. And Jokowi wasn't able to do that, even though he did try.
How urgent is that, given that certainly at Bloomberg Economics we've run some sort of modelling around stress tests involving, a sudden change in interest rates, in currency, in growth conditions and those sort of shocks, and it would ratchet up that debt to GDP pretty quickly. Is there a concern that those sort of policies really need to take priority, particularly as we live in, as we've just seen over the last few weeks, a world where these sort of shocks are not necessarily that shocking?
Yeah, I think for a little while there, some of the elites close to Prabowo and those who we sort of understand to be sort of advising him on, how to design kind of his approach to economic policy, there was talk about sort of just raising the debt ceiling, in fact. And that sent a few shockwaves through markets. And it was sort of suggested very quickly to him, or indicated very quickly to him, that wouldn't be an option. So I think it is a real challenge. Having said that, Indonesia is known for actually having very prudent macroeconomic policy. And a lot of this will depend, I think, on who, to sustain that sort of reputation and that kind of approach to the economy. A lot is going to depend on who Prabowo appoints as his finance minister. And so that's what people are going to be watching very closely. Obviously markets have always been the last 10 years have been very appreciative of the role that Sri Mulyani has played as finance minister in the Jokowi administration. She won't be continuing in that role, but there are many other options, right, in terms of sort of good, well-respected, internationally technocratic ministers who can fill that post and can manage what is going to be a very challenging sort of time moving forward. But the economy overall, it has these structural problems that do need to be addressed. But I think, most observers believe that Jokowi leaves office with, at the very least, a sort of stable set of macroeconomic credentials.
Eve Warburton, Director of ANU's Indonesia Institute, is there with us. More ahead on the Asia trade. This is Bloomberg. Watching BHP at the moment in the Sydney session this Friday. Of course, we're watching the strike at BHP's Escondida mine in Chile, now entering a third day, really extending that stoppage at the world's biggest copper operations. And we have seen fresh attempts to resume those talks. Of course, the midweek attempt ended with no success. We are seeing BHP perhaps reflecting some of the sort of positive expectations from these talks, up 2% at this point. Let's bring our metals and mining reporter Paul Alan Hunt for more. So, if production output from the Escondida project is reduced, do we see a meaningful impact on copper markets?
We certainly could. Escondida last year alone produced 1.1 million tonnes of copper supply. That's about 5% of global copper supply, so it's certainly not insignificant. It's the largest copper mine in the world. The tussle between BHP and the unions, as you said, is reaching its third day, or we are well into the third day of it. That attempt earlier this week by BHP, the offer of $28,900 as a bonus to every single of the 2,400 workers at Escondida, got rejected. They want 1% of shareholder dividends from the mine, which would be about $36,000. BHP has activated its contingency plan. We're not entirely sure exactly how much production has been hit, or if production has been hit yet. But it comes as BHP heads into its earnings season. We understand that workers are camping out at the export port and that there might be output losses from the concentrator at the mine too. It's worthwhile mentioning that in the past BHP has had to declare a force majeure on Escondida due to previous circumstances associated with unions.
Paul, just quickly, this is not the only union challenge facing BHP.
That's right. A new coalition between the Australian Workers' Union and the Mining Energy Union of Australia has been formed in the northwest of Australia, where BHP's major Pilbara iron ore mines are located. It's unclear exactly what they're after yet, but a similar coalition was formed in the oil and gas sector, and that saw massive pay rises across the entire offshore oil and gas sector in Australia.
Metals and mining reporter Paula Lan Hunt there with the latest on BHP. And that's it from the Asia trade. We continue to watch the ongoing typhoon approaching Japan right now. More than 500 domestic flights canceled, more than 90 flights also to international destinations canceled by ANA and JAL, disrupting roughly 100,000 travelers across the country. And of course, this as bullet train services has already been stopped between Tokyo and Nagoya, and authorities really warning of possible landslides and flooding as well. The China market opens are next. This is Bloomberg.